can go ahead and get started. So today, we're going to do a little interview or Q&A, however you want to call it, with Darren. Darren's been in the industry quite a while, but today we want to go over some ways of working with your clients, whether you're on the listing side or the buyer side, with the mortgage officer as well. So this is intended to help you look for red flags. If you're a listing agent and you're getting all these pre-approval letters over and you're just not sure, how strong they really are, or maybe you don't know the right questions to ask the buyer's agent or the buyer's lender, if you're on the listing side, to see how qualified they really are. We're going to cover some basic mortgage guidelines, and then some other tips for when you're on the buyer side of the transaction, to help you close the deal a little easier, to prevent headaches, maybe structuring the offer correctly up front and things like that. So this is just some basic mortgage information that basically all realtors should really know. Before we get started though, we're going to have Andrew give us a mortgage update. How's it going, Andrew?
It's good. Yeah, this actually sounds like some good information. For rates and what's been going on, my suggestion to all of you, if you're speaking with buyer clients or sellers wanting to buy, is have them suggest that they don't pay attention to these daily and in the moment, call them rate spazzes. I mean, I saw last week through my email and the lenders that we work with, I must have seen, I don't know, in 5-day work week, 15 different price adjustments from different lenders throughout the week. And that's showing like the rates pop up in the morning, and then I get an update because there's been a change, positive or negative, at 11, sometimes again at 3, and that changes all throughout the week. So it was pretty active last week. Starting out this morning, let's say my unicorn buyer, he works at the post office. He makes about $11,000 a month in income. He's buying FHA with just 3.5% down on a $800,000 property. His loan's going to be right around $750, and that he's got about $2,000 in credit card and car payment debt, things like that. He's buying a townhouse, so there's a HOA of $350. This guy's rate is showing up two different options, right at 3.5% and 3.625%. The difference of those two loan rates is actually a difference of looks like $7 over the course of the 30 years. So we're still at 3.5% starting out the week. I think that's strong going into spring. But if your client is affected by what's going on in the market, and they're connected to lenders, or their news feed is being fed with real estate information, I would really suggest to them is to avoid getting too excited about that, because until they've locked their rates, none of these numbers really matter, and they're probably never going to lock their rate until they have that purchase contract in hand. So at that point is when you want to start really fluctuating and kind of watching the market for that ideal day. But we're still in a good spot. So 3.5% for an FHA with only 3.5% down. I mean, if you've got a buyer with 25%, a much higher, loan to value, you're gonna have a guy probably in the lower 3s still if he's got good credit. So that's it for today. Let's hear what Darren has for us. Thanks.
Sounds good. Good info. All right, so we have Darren on today. He's part of our team here at Tried and True Home Loans. Good morning, Darren. How's it going?
Good. Thanks for having me. I really appreciate it.
Yeah, not a problem. Thanks for coming on. So I guess we should start with maybe just a little quick background of your mortgage career. So can you give us a quick background of your experience and I
Sure,
guess where you're at today?
absolutely. Yeah, so I've been in the mortgage and real estate industry since 2002. I started working for a wholesale lender back then, so I learned the whole lending side for the first 8 years in the industry. Then I went on to run my own retail branch out in Hawaii, actually. So I had experience with that for about 4 to 5 years. And then, I got my real estate license and my loan originator license in California. So I've been doing that ever since. I even dabbled in some commercial real estate for about 3 years as well. So I understand that side of the business if anybody has any questions about that. But yeah, I pretty much seen it all. I went through the crash in 2008 and, just stuck with it and was able to build a nice career off of, mortgages and real estate. So I've had some underwriting experience as well as appraisal review, docs and funding on the lending side. So I really understand that side well. So I know what these lenders are looking for when it comes to, conditions and underwriting and everything like that. So I'm glad I could be of service to you guys.
Yeah, awesome. Cool. Well, let's start with, I guess, maybe the listing side perspective. If you're a listing agent, maybe some things we should be looking for. So if I was a listing agent, I had a property, what should I be looking for in a pre-approval letter to determine, what stage of the loan application the buyer is in?
Sure. So when you look at the pre-approval letters, it's always going to obviously have the amount that they're approved for, but then there's going to be some fine print that the lender puts on there stating, whether it's conditionally approved or whether, this pre-approval letter is based on the following conditions. And usually it'll say like a full underwrite, appraisal review, make sure that the income comes in as stated. So you just want to look for those things that it says under the loan amount that you're pre-approved for.
Okay. So we do have a sample of one, if you want to maybe take us through it, that we had come across, and we kind of questioned it a little bit because it looks real official. I'm going to go ahead and display it. So we did receive this. This was not one of our loans that we approved, but we did redact some of the information on this. This was an actual pre-approval that came across, and it looks real official, doesn't it, Darren?
It does. So this is a little bit different than a pre-approval. This is a conditional loan approval, which is usually given after it goes through underwriting by the bank. So it'll obviously have all the loan terms up top, and then I'm sure there's like a list of conditions below.
There is a list of conditions below, but what kind of struck me was they didn't have a FICO score stated on here.
Yeah, that's a red flag right off the bat.
Yeah.
Yeah, because how can you give an approval if you don't even know what their credit score is?
Yeah.
Yeah.
There was just a few other things, that kind of stood out to me that made me question, as a listing agent, how legit is this thing, Well, so they did. Go ahead.
And normally up top, they'll have the bank name, like the letterhead of the bank and everything like that. Like they make them look really official. So, this looks like
it did have that. I wanted to redact it because I didn't want to throw anybody under the bus, but
Okay.
there was a logo and some information at the top. I did remove that, but everything else I just kind of blocked out. So yeah, that's where we ended up. So yeah, there was no FICO scores. Is there anything else on here that you think was kind of a red flag as we kind of scroll down?
I mean, they're quoting a rate, and for anybody to quote a rate without a credit score, the first thing an account executive for a lender is going to do is go to their rate sheet, and they'll see what the credit score is, what the loan to value is, and that's when they'll quote the rate. So for them to be giving it a rate without even having a credit score is, it's not legitimate. Like,
yeah. All right. So they did have conditions and things as we went down. looked like most of them were kind of pre-printed. But like I said, this, as a listing agent, this looked real official until I started kind of looking through it and noticed the lack of credit scores and things like that.
Plus, you can see it looks like they just added every single condition known to man on the conditions. Like each loan is specific and different, right? So you might submit a loan with all the income docs, assets, everything, and to underwriting, and they won't condition for that. But this, they just threw every condition possible on there from what it looks like. You're just throwing it against the wall to see what sticks, but that's kind of a red flag too. You're never going to have every single condition known to man on the conditional approval. So
yeah, especially the cash out part right here.
Yeah,
I don't think we would have that if it was a purchase.
Right. You'll have your boiler like template conditions, like title, HOI, stuff like that will be on every single one. But this one, I think there was something like 26 conditions on there, which the most I've been seeing, on my approvals are maybe like 10, 12 conditions. So.
All right. So that's a good one. So if you see something like that come across, no FICOs and they're quoting rates, you might have a red flag there. You might want to kind of dig in, ask the buyer's lender some questions. And that leads me into my next question, I guess. So as a listing agent, what should I be asking the buyer's lender to help determine the credit worthiness of this buyer?
Sure. And it's not even what you could ask them. I would flip that and just say, what are lenders looking for? Pretty much every lender out there is looking for the 3 C's. The first being credit. They want to know what the credit looks like and what the credit score is. The second being capacity or capability to repay the loan. So they want to see your income and they want to see your assets to make sure that, hey, if we loan you $600,000, you have the ability to repay the loan. And the third one's the collateral. They want to see the appraisal to make sure what the property is worth and what they're loaning on has the true value of what we're saying it is. So that's what every lender is looking for, the 3 C's, credit, capacity, and collateral. So yeah, as long as you have that down packed, then you should be fine with the lender.
Okay. What should we be asking to see if they are even capable of closing in the 30 days or 21, or, some of these buyer's agents are really just throwing out these numbers to try and get their offer accepted. And I know when I'm on the listing side, that's a question I definitely ask the lender. It's not so much that I want to hear the truth from them. So,
sure.
No,
it's a great question.
Yeah. And
each lender is different. So what I do is I always ask them first, what is their underwriting turn times? It should be anywhere from 24 to 48 hours. If they're telling you it's like a week long, then that lender is going to take more than 30 days to close for sure. After that, I would ask them, how long their typical appraisals are taking right now, even though, they're not the ones who are actually doing the appraisals. They know their turn times for how well or how fast the appraisals are coming in. And then you got to ask them, it's crazy because today's so different. Like back in the day when I was an account executive, I could just go to my underwriter and be like, hey, what conditions do you need? I'll get them right now. Can you sign off on them? Today, account executives at lenders are not even able to talk to their underwriters at most places. Like even UWM, which is a huge lender that we use, the sales guys can't talk to their underwriters at all. So they just have to submit the conditions and hope they get a fast answer or turn time, which UWM is good with. But yeah, I would ask how long underwriting takes. Then I would ask how long does it take to clear conditions, because they have to submit that separately. And then I would ask them how long docs and funding takes. Like once all conditions are in, once the appraisal's in, how long does it take to submit and get an approval to send docs out, which should be, again, 24 to 48 hour turn time. But those are definitely important questions to ask them.
All right, that's good info. Now on the pre-approval letter, does it have to be for at least the amount of the home, even if they're putting down 20%?
Yeah, I mean, every pre-approval that I send out, I want it to be the amount of the purchase price at least, because if you submit one that is under the purchase price, the listing agent might not accept your offer, right? Like they're going to say, well, if you're submitting one for 2.4, but the purchase price is 2.6, even if you're putting 20% down, they might not think your offer is as strong as somebody else's offer who has a pre-approval letter at the full purchase price amount. So I would always have the full amount on there for sure.
Okay. Now they could still buy the home if they had the assets, right? So, I mean, if they were only approved for, 2.2 and they're offering on a 2.4 house and putting 20% down, the 20% is going to be off the 2.2, right? So they'd have to come in with the extra 200,000 above their 20%, right?
Correct.
And the lender wouldn't have a problem with that though.
No, the lender won't, as long as they have enough money in the bank to cover the 20% and they approve them for the loan amount that's say 80% loan to value, then no, the lender has no problem with that.
Okay. So let's start getting into the buyer side. So conditional loan approval. What constitutes as a conditional loan approval? And when we get the conditional loan approval, can we release the loan contingency at that point?
So conditional loan approval, the loan has actually gone into underwriting. You've submitted, the 1003, the credit report, the income docs, the asset. The underwriter reviews everything, makes sure that they're approved for the loan, that the debt to income ratio is, 50 or below in most cases, and the LTV stands and the rate's good and your credit score is good. Then they're going to give you kind of like that list that you just showed, but hopefully not 26 conditions on it. They're going to give you an approval with conditions that need to be met in order for the loan to go to fund and close. So you can't remove the loan contingency just because you have a conditional loan approval. You first have to clear all those conditions and pretty much have almost like a clear to close before you remove that loan contingency. Does that make sense?
Yeah, it does. So we're talking about two different things. I mean, if they say, hey, we have conditional loan approval, we don't want to release that loan contingency. The chances of them getting the loan are good, but then there's still things they have to do, correct? So there could be a condition on there possibly that they may not be able to clear for some reason.
That's exactly right. And if you lose your loan contingency, if you just, waive that or let it go just because you have an approval, and then for some reason you can't clear that condition, then, your deposit's pretty much gone. So you always want to keep that loan contingency on there until you have cleared all those conditions from the conditional loan approval.
I guess over the years, can you give any examples of things that have held up a loan after the conditional approval, like a condition that just that we couldn't clear for whatever reason?
Yeah, so some lenders will ask for the most recent tax returns. Like I'm going through that right now. One of the lenders is asking me for a 2021 tax return because they want to see that income, and my client has not filed that yet. So, I'm telling them to rush and get it done as soon as possible. They use a CPA who's telling them that they can't get it done for like 3 to 4 weeks because they're pretty backed up. So we're looking for alternative options for that right now. But that's part of the loan contingency, obviously the income docs, and they want to see that to qualify. So
this is kind of an awkward time of year.
Very awkward.
I seem to run to quite a bit in between now and April 15th, I guess, that, these lenders are conditioning for the 2021 tax returns, and a lot of people haven't filed yet. So I guess if someone's working with a buyer right now, that's maybe a question that they should ask if they have filed their taxes, and let them know that the lender may condition for that.
Absolutely.
All right. So what's the difference between a pre-approval, and the full approval? When the boxes are checked in the RPA, that's a new option for us in the RPA, is to check one of those 3 boxes. And how can I verify that the proper boxes are being checked?
And that's a tough one because, there needs to be more training on the new RPA for sure, I believe. A pre-qual to me, and you could ask 10 different people and they'll probably explain it with 10 different options. But a pre-qual is when I take an app over the phone from a borrower. They tell me their credit score. They give me their income information. I pull credit, I look at everything as a loan officer, and I tell them what I believe that they qualify for with my knowledge in the industry. A pre-approval is when I take that same information and I send it to my lender. And the lender takes a look at income, credit, all of that. And they say, yes, we still have to put this in for a full underwrite, but based off of what you sent me, here's the amount that we believe your borrower is pre-approved for. And then a full approval is when it goes through underwriting and they give you that conditional loan approval, like the sheet that we were looking at earlier. So it's tricky on the RPA, to tell you the truth. I think you need to be very careful which boxes you check, and I wouldn't even really check pre-qual. Like I would probably get it in the pre-approval status first, like have a lender look at it, because as loan officers, we're not even supposed to write a pre-approval letter without having that lender take a look at it first, because then it's still in pre-qual phase. So we're not supposed to write the pre-approval letter until a lender has said, hey, I've looked at this and this is what they're pre-approved for amount. So.
Okay. So in our previous example with, this one that came through, it does say conditional loan approval. It sounds like there's a chance that they maybe checked the box on this one, that they had, that it was further along than it really was, that maybe they said full approval on that versus, I don't even know if this is actually a pre-approval. I would almost consider this one a pre-qual almost, because they don't have FICO scores, right?
Right. Without the FICO on there, it's definitely a pre-qual. I mean, we don't even know the credit score. So again, like, how do you know what LTV they qualify for? How do you know the rate that they qualify for? This to me is a pre-qual. But when I send a deal to a lender and I get that conditional loan approval, just like this, that's when I know I have a full approval from my lender.
Okay.
And it looks very similar to this. So you have to be careful, but it will always have the rate on it. It will always have the FICO score on it, so just watch out for those red flags.
Yeah. So this may have been presented as a full approval on the RPA with that box check, but now we can arm ourselves and say, hey, this is actually a pre-qual. I think I need to call up this lender and get some more info here.
Sure.
So, okay. So let's talk about some loans. What requirements, if any, should be considered if a buyer is using a 20% down loan versus a 5% or 3.5% or even a 0 down payment?
Yeah, I mean, so the requirements that anything less than 20%, you're always going to have mortgage insurance, which is just an added cost to your borrower. There are programs that just came out through UWM where I think it's 89.99%. So if your borrower's putting 10.01% down, they will eliminate the mortgage insurance for you, which is good, because you don't have to pull the full 20% down. But the requirements for underwriting, each lender is going to have their own different guidelines. So it doesn't matter if it's 80% or 3%, except for, 80% is usually a conventional loan. So you could put that through Fannie Mae and you could get, your lower rates and everything. And then what happens is with Fannie Mae, they put it through a DU, which is, direct underwriting, and it spits out a conditional loan approval like we were just looking at, the DU findings, but they're usually a lot less conditions when you're doing a conventional loan than, something like we were just looking at before. So you'll get findings through your DU, which we could explain a little bit more later, but those findings are usually pretty easy. Like I have a deal going on right now and they're just asking for a couple of conditions, like 2 or 3, and then we get closed. And sometimes they'll even waive the appraisal on conventional loans. You're always going to have an appraisal on those higher LTV loans, 3% down, no percent down. So it just really comes down to, how easy it is to clear those conditions.
Okay. So they're not necessarily riskier or safer. It's just a matter of, can they clear the conditions? So
well, it's always riskier to the lender if you're putting less money down. Hence, you probably get a higher interest rate on those deals. Especially like if you do FHA, you might get the same interest rate, but then you're paying that mortgage interest. So it's a higher payment. So that they want to protect that if you do default on the mortgage, that they're protected. So that's where the mortgage insurance comes in. So you'll always have a higher payment if you're putting less money down, obviously, but tack on that mortgage insurance too, and it could get pretty hefty.
Okay. So loan points. So loan points are referenced in the RPA, and I'd say 9.5 times out of 10, they are not. It's not filled in, and we're talking about section E1 of the new RPA.
Sure.
So what does it mean when it says the buyer to pay 0 points or up to X amount of the loan amount?
Yeah, so typically you either have lender paid points, which means the lender is paying our commission, or you have buyer paid points, borrower paid. You could charge up to, on some deals, believe it or not, you could charge all the way up to 5% if they're called non-QM loans, which we could get into a little later. But typically, we'll charge 1 to 2 points to the buyer, or I'm sorry, the borrower, if we're not getting paid by the lender. And we have to disclose that as loan officers. And now apparently, the real estate agents have to disclose it on the new RPA as well. So it's tricky because realtors never know. They usually don't know how many points that we're charging their borrowers. They don't ask that up front. But now it seems like we're going to have to get into that, that just mode that we have to ask about how many points are being charged on the deal as real estate agents, because they want us to close it on the RPA now. So, but it's just a percentage of the loan amount. Again, like typical is like 1%, maybe up to 2% of the loan amount as our fee. And if we can't get paid by the lender, we have to get paid by the borrower.
Okay. Does it matter if the loan is changed during escrow, say from pre-approval conventional to an FHA loan?
It can matter. I mean, everybody just cares about the loan closing and just meeting the dates that are in the original RPA. But say you have a conventional approval and then all of a sudden you're switching to FHA. Well, FHA could take longer to close. So, if you're dealing with a realtor who does not want to extend the closing date, then yes, you could have an issue there. Typically, everybody's trying to work together just to get the deal closed. And if you have to extend 10 days, then, it's not that big of a deal. But I've seen it before to where people can definitely make a hassle out of that. So you want to be careful with that.
Okay. And we should remember too, when we're going through the RPA, if you stated in the RPA that they're doing conventional financing, and then, if you switch it over during escrow over to an FHA loan, you wouldn't be able to actually cancel if they got denied at that point for that FHA loan, because the contingency was written for a conventional loan at a certain percentage down. So, that's something to keep in mind, that you want to probably, throw an addendum in there stating, that you're switching it over, get everybody to agree so you can get that contingency back in place for your buyers. So otherwise, they would have to get the loan denial if that happened on the conventional loan and not the FHA loan in order to act on their contingency, or to be able to act on their contingency. So that was done. So let's see. When can a loan contingency be used to allow a buyer to cancel without losing their earnest money?
Pretty much, if you said loan contingency, right?
Correct.
Yeah. So anything that comes on that conditional loan approval goes towards the loan contingency. So if a requirement can't be met and they're going to kill the loan because of that, then you should be able to get out as long as you're still in that loan contingency period. If the lender denies you for any of those conditions not being met and you're in, say, that 17-day grace period, you just have to show, that the lender denied it because it couldn't be met, and you should be let out of that contract. That being said, if you obviously, like Travis was just talking about, you switch from conventional to FHA or something like that, that was your fault, then you're probably going to lose that deposit. But, you know, if everything stayed the same as the original approval on the RPA, and you were just denied the loan because the lender, you know, you couldn't meet one of the lender requirements, then you should be let out of that loan contingency.
Now, do you think, you know, how soon in do you think you would be able to know if you're going to get this loan through or not? So let's say you get it accepted, you're in the pre-approval stage, I guess we'll call it. You're in the pre-approval stage, and you know, do we need to go the 17 days? How soon typically do you know if you're going to be able to close this loan or not after you get the deal accepted and you're moving forward with things?
I mean, you should know right when you get that loan conditional approval, and that should be within like 48 hours. The lender should have that back to you. You should, and us as loan officers should be able to review that right when we get it, see what conditions are on there, reach out to the borrower that day, and just make sure that we can clear all those conditions. And if there's going to be a hiccup, you know, we should know about it within the first 72 hours. So you should never need the full loan contingency unless it's something out of our hand, right? Like, you know, title comes back with liens on it, or, you know, there's something like that. If it's a condo and it's a questionnaire, or I'm sorry, the HOA is bankrupt or something like that, something that we couldn't foresee. Other than that, we should be able to know within 72 hours, in my opinion, whether the deal is going to get done or not.
Yeah, that's good info. So if you just have a single family home, no HOA, you know, you should be able to maybe ask the lender after a few days if, you know, how those conditions look, if they're going to be clearable or not, right?
Yeah, absolutely.
All right. What if your offer is accepted based on pre-approval from Bank A and you get a better rate from Bank B?
That's a good question. I mean, the approval is based off of everything that you submitted to the bank, right? But we also have a fiduciary responsibility to get our borrowers the best deal possible. So if you submitted it to two lenders at the same time, which we do all the time, and one just took a little bit longer getting back to you, but comes back with a better deal, as long as you could close it in the time frame that's on the purchase agreement, I mean, in my opinion, you always have to go with the best deal for your borrower. And lenders get it. I mean, they understand that they're competing against each other. I even tell them when I'm submitting it to 2 or 3 lenders, you know, I have upfront relationships with these guys, and I just say, hey, look, you know, it's going to your competition too, just in case you can't get it done or we get a better deal through them. You know, they're fine with that right now.
Okay. We do have a quick question. Have you worked on any rehab loans, like those 2 or 3Ks or anything with FHA?
I have not. No.
You have not? Okay.
No, I have not done any of those.
Okay. Well,
but it brings up a good, like, I work on what's called a DSCR loan, and it's debt service credit ratio. It's not usually for rehab, but the cash out from it can be used for rehabs. They'll do up to like 85% loan to value on investment properties. You do not need to show income. You just have to have a good credit score, and they're going to do an appraisal in the area, and they'll use whatever the appraiser says the market rents are in the area. They'll use that amount to qualify you. So say it's $2,000 is the market rent in that area, and they want your mortgage payment to be at least $2,000 or less. So as long as it's like a 1-to-1 ratio there and you have a good credit score, they'll approve you up to 85% on a cash out refi. Yeah.
All right. So
rehabs.
Susan, we could probably talk offline on that rehab loan if you have something there. I have a little info on that I can give you. So let's talk about appraisals real quick. If the appraisal comes in under the contract value, so we have the purchase price, which is the contract value, and the appraisal comes in short, which is super common in the industry right now. And I don't agree with that value. Is there anything I can do? You know, if I just think that this appraiser just really didn't bring the property in at value, they didn't use the right comps, or maybe I saw better comps. You know, is there anything I can do about this?
Yeah, I mean, we're not, obviously we're not allowed to talk to appraisers anymore, but the third party companies that we order the appraisals through, like Class Valuation, we can call them and we could send them supporting evidence. Like you just said, we could send them comps that we would like the appraiser to take a second look at in the area that we found that we feel would increase the value. And again, they'll put that in front of the appraiser and see what we get back from there. So there's definitely an option. We don't just have to sit on it. We just obviously can't talk to the appraiser direct.
Okay. And getting a second appraiser out there, that's probably not something that would be prudent, right?
Well, no, because they'd have to pay for a whole new appraisal then.
Yeah.
So it's best to just put it through the third party service and show them, just make a good case for it and they'll go back and take a look at it for sure.
Do you have any insight as to maybe appraisal guidelines when an appraiser is looking at a property and pulling in their comps, like what kind of criteria they're looking at to choose the comps that they are using?
Yeah, I mean, they always want to stay within that half-mile radius. If they have to go out a mile, they will. But they like comps that are very, very similar, right? So stuff that's sold on the same street obviously is best. And just as like models as possible, when it comes down to beds, baths, square footage, whether there's pools or not, just pretty much your basic stuff on appraisals, but they definitely want to use the most like comp as possible. So, and as close as possible.
Yeah. So if you find one that's maybe outside that mile marker that you want them to use, they may not even consider that because they're trying to stay as tight as possible. Right.
Exactly. Yeah.
Yeah. All right. Let's say the buyer says that they're going to waive the appraisal contingency in the offer. I mean, do we still have to get an appraiser then?
It's definitely not up to the buyer. It's up to the lender. So if the lender wants the appraisal still has to be done. Even if they waive that contingency and we send it to underwriting, hopefully we could get it to where, usually on conventional loans today, if you're running it through DU and you have a strong borrower, they'll give you a waiver of an appraisal. So you won't have to have it done. But I do a lot of non-QM loans too. And those almost 95% to 100% of the time, you're going to need an appraisal done, even if the buyer waives the appraisal contingency. Okay.
So in the appraisal waiver, I mean, sometimes they seem to be kind of random. Do you have any insight as to if you think we're going to get those, or when would we know if we are going to get an appraisal waiver?
You're not going to know, to tell you the truth. In my experience, you just got to submit everything to DU and see if you get that. The stronger the borrower, the lower the LTV, the lower the DTI, the more chance you'll get that. So, if you have like 70% loan to value, you have a 760 credit score, you have good assets, good income, and your DTI, your debt to income ratio is below, let's say, like 35%. And don't quote me on this, but typically, obviously, the stronger the borrower and conditions like that, then you should get an appraisal waiver.
Okay.
Yeah.
I also heard it has to do with the volume of sales in that neighborhood too. If there hasn't been anything really recent, then you may not get the appraisal waiver. But if there's a lot of sales going on in the neighborhood, that can increase the chances, along with what you just said as well.
Sure.
So because then, they have some information on the property that's recent, as far as values. Okay, non-QM, you've mentioned this a couple times. So what is non-QM financing and how does it differ from traditional A-paper stuff?
Sure. So non-QM is just non-qualified mortgage. It's just not conventional. Doesn't fit Fannie Mae guidelines. It used to be called subprime back in the day, and obviously that got a bad name. So now they just call it non-QM. But it's a great way to qualify your borrowers if they can't qualify traditional full doc income. A lot of great programs out there right now, like the bank statement program. I just did one for a self-employed borrower, just to give you an example. She owns a nail salon. She showed nothing on her tax returns, like couldn't even qualify to buy a $700,000 house. we used 12 months of her personal bank statements, and she was putting all of her money from her nail salon in the statements. So she was showing $30,000 a month in deposits on her bank statements. And we were able to use 100% of that income to qualify for her for a $2.5 million purchase in Bonsall. So she was so happy about it, obviously. I mean, she was a strong borrower with her credit and everything, but you don't need full documentation. You don't need W-2s. You don't need tax returns. As long as you could show a lot of money going into your bank, we could get those deals done. And that's considered a non-QM because you can't put those through conventional financing methods. So, but there's a lot of programs out there like that. Some are called like bridge loans, where you could take a loan out on your house that you currently own to go buy your new house. And you won't have a mortgage payment on the house that you live in now for up to 12 months. You have up to 12 months to sell that house. You will obviously move into your new house right away, but those typically you have to do with the same lender. You'll have to sell your house to the same lender who's giving you the money to buy your new house. So, and then they have asset loans also, where, sometimes they'll use 3 months, 6 months of just how much assets you have in the bank to qualify you for a purchase of a house as well. So just anything non-traditional, non-full doc, that's considered pretty much a non-QM loan. And we can talk more about those deals if anybody has a scenario like that offline.
Okay. Stepping back real quick, I have a couple questions. So getting back to rates on the RPA, how will the buyer know if they're paying or a loan company is paying, and can the buyer negotiate the rate? So I believe they're talking about borrower paid and lender paid.
Yeah. So, I mean, typically we have to disclose that whether it's borrower paid or lender paid. So we could just disclose it to the actual borrower because it's on all the documents that they have to sign, whether it's borrower paid or lender paid. They could definitely negotiate the rates, and the rate could be bought down. And some of that could come out of the lender. Like if the lender agrees to pay us, say 2% as a loan officer, we could say, all right, you know what? I'm only going to take, let me step back for a second. They agree to pay us 2% at say a 3.99 rate. And I say, you know what, just pay me 1% and give me a 3.5% rate. So it's typically, we're giving up some commission to buy down that rate for the borrower. And then, and then the borrower could always pay half a point or a point, which is 0.5% of the loan amount or 1% of the loan amount, to buy down the rate if they would like to.
Okay. And Paul, I think that goes back to, you asked, does it have to be disclosed on the RPA if it's lender paid? I don't believe so. I think we're talking about, if we're going to be charging the borrower the points, they can choose if it's going to be more than, let's say, 1% on the RPA, and the lender is going to be charging them more than that would be part of that loan contingency. Quick one from Anheed. How come we cannot let the appraiser know what was called out on inspections when the appraiser hasn't called it out? Aren't we supposed to be protecting our client as a realtor and as a lender?
Say that one more time.
How come we cannot let the appraiser know what was called out on the inspections? I believe she's talking to like the home inspection findings when the appraiser hasn't called it out. So there's things on the home inspection that were called out that the appraiser did not call out. So I guess let's flip that around and say, what is the appraiser looking for that may be called out as an appraisal condition?
I mean, that's a tricky one because each appraisal is different. So I see what they're asking though. Why can't we talk to the appraiser? And it's just, the reason, a big part of the reason that the crash happened was because a lot of lenders were talking to the appraisers and telling them this is the value we need no matter what. And the appraisers were just fluffing the appraisal values of homes. So, when the government stepped in, they made it just to where we are not allowed to talk to appraisers on anything on the appraisal. We have to go through the third-party companies. So that being said, we could always put notes in to the third-party company that we want some questions answered about like the home inspection and what was done and why it was done. And we could always have the appraiser go back out there for an additional fee if some things we feel need to be changed or necessary to be changed to get the deal done. We just have to put it in the notes section to the third party company and let them deal with the appraiser. It's just the way the business is ran these days.
Yeah.
Yeah,
Okay.
we really have no say in that.
Yeah. So what are some of the stand apart programs offered through non-QM? I know we touched on a couple of them, but you know, who best benefits, I guess, from these types of loans, these non-QMs? Because I know a lot of times we're thinking, oh, you know, the credit score is low, or we can't prove the income, or they're self-employed, and we can't get them a loan, you know. But these non-QM products, you know, I have to say, I feel like the lending is pretty loose when it comes to who can get a loan these days. Not quite, you know, 2006 standards, but you know, it seems like it's definitely loosened up with this non-QM stuff.
Yeah, and who benefits the most? It's in my, I believe that the buyer or the borrower benefits the most for sure. I think self-employed for sure, because I'm self-employed and I write everything off on my tax return. And the only way I could qualify to buy a house is through the bank statement alone. You know, as long as you show that those deposits going in, they could use business bank statements or personal bank statements to qualify you to buy a house. Like that example I just gave you guys before with the woman in Bonsall, she didn't even think she could buy $1 million house, and we got her approved for $2.5 million. So it's definitely the borrower benefits the most. Self-employed for sure. People with lower credit scores for sure. You know, there's financing available. We're signed up with at Tried and True. We're signed up with, I believe it's about 15 lenders now, and some of them I've been using for a while, and they have really good programs out there that I can start sending you guys just to go over some different cases and different scenarios. But
yeah,
you know,
I see some of them, and I can't believe some of these programs of how easy it is to qualify actually.
yeah, and as real estate agents, you guys should really be looking at bridge loans, because a lot of people believe that they have to sell their house before they buy their new house. They already found their dream house that they want to move into. They're like, hey, I have to sell my house first. It may take a while. You know, it's just not the case anymore. Like the lender will lend you the money on your old house to go buy your new house. And you don't have to make a mortgage payment on that old house until you sell it, which is great. And they don't use that old house, the mortgage payment, to qualify for the DTI to buy the new house. And you just have to make sure that you sell that house within 12 months. So to me, that's very powerful for a real estate agent to be able to go out there and say, look, you don't need to sell your house to go buy this house that you love right now. We could work that out with the financing.
So this sounds like a really good objection handler if you're talking to you know, some homeowners that are really nervous. I mean, that's probably the number one objection right now is, hey, I want to sell my home and, you know, cash out on this equity, but where am I going to go? You know, there's nothing to buy. There's no inventory. What do I do? You know? So that sounds like it's a really good option, actually. Yeah, definitely. Virginia's asking, what are rates on the self-employed program?
It varies, definitely, depending on your credit score and the loan to value. But typically rates on that program, the one I just did for the woman in Bonsall, we got her to a 3.5. But that was before the rate hike. So I'd say right now they're probably starting at right around 4%.
Yeah, which is not bad. You know, I mean, it's a higher risk loan for the bank. So, you know, they're going to charge a little bit extra, but the borrower gets a house. So I think it's a really good option. It's a small price to pay, in my opinion.
Exactly.
You know, a little bit of a rate bump. So, all right. Last question, and this is a question that comes up a lot. Nobody knows what it is. DU approval. What does DU stand for? And how do we know if the buyer truly has this? If I'm the listing agent and the the buyer's agent say, oh, they have DU approval, they have DU approval. Okay, what does that mean? And how do I know? How can I verify?
It's just direct underwriting. It's just Fannie Mae's underwriting approval. And how you know is, here's what happens. It's just like a conditional loan approval that you submit through any lender. They're going to upload income docs, credit, and assets, and a 1003. And then they're going to press a button and it's going to spit out whether you're approved eligible or you're not approved. It's as easy as that. And once it says you're approved, it's going to give you a list of those conditions that need to be cleared in order for you to close. So if they're telling you that they have a DU approval, just tell them to send you the eligibility loan approval. And it's just like a loan approval that we showed before, minus the 26 conditions on there. But it'll have everything. It'll have the borrower's credit score, it'll have their name, it'll have the conditions that need to be met in order for you to close. But that's just for conforming deal, conventional conforming deals, meaning it fits Fannie Mae's guidelines and, you know, typically better rates and easier to close.
Okay. So can you get DU approval on everything? Like, or are some loans just not going to run through that system?
If as long as it fits conventional guidelines, then yes, you can get a DU approval. If we go bank statement loan, absolutely not. You know, if we do any of those non-QMs that we were just talking about, then no, you won't get a DU approval. But if it's a traditional full doc loan, you know, meets their LTV requirements, it meets their DTI requirements, then yeah, you should get a DU approval. Okay.
So yeah, if you're working in a higher price point, more than likely, we're probably not going to see that DU approval on many of these, because you might have a self-employed borrower or something on the other side. And so if you're demanding the DU approval, it might be something that they just can't produce, but it doesn't necessarily mean that they're not going to qualify for the loan, right?
That's correct. I mean, we should always try to get them qualified, whether it's non-QM or DU. And if you guys just think that they don't qualify because they said it was ineligible through DU, always give us a call and let us see if we can get them qualified. Like Travis, the borrower that you just sent me recently, they weren't getting a DU approval, and they were questioning why. And we ran it through UWM, which is one of our lenders, and we got them approved. And the reason why, they were using Social Security income, but they weren't increasing it, because Social Security income, because it's a fixed income, you could increase to 125% of the income and use that extra income. And right when we did that through UWM, we got an approved eligible. Now we're going to close that loan.
That's awesome. So you got to make sure that you're calculating these things correctly, right? That's where the experience comes in, you know, on the loan officer side, is like, you know, knowing these guidelines and making sure you're calculating income correctly and submitting it to the lender correctly. So basically it sounds like it was just a little, you know, rework of the income, and then that made it happen.
That's exactly right.
Yep. Cool. Well, I don't see any more questions in the chat. That was super informative. I really appreciate you coming on, guys. If you have questions, you know, if you have a hot buyer that makes a lot of money but they don't show it, give us a call. We can probably get that loan done. Don't think that they are, you know, out of the running for a home, because there's a lot of programs out there these days that, you know, can get just about anybody qualified if they have, you know, income and the ability to repay the loan, you know, and a decent credit score, it seems like. So we got Darren's contact there, but you can always contact me. We have, you know, 8 other LOs here too as well. Some of them specializing in different things, but you know, Darren, he's got those the non-QM stuff down pat. So we have a lot of options for that. Other than that, yeah, I don't see any other questions. I appreciate everybody coming on. Hopefully, you know, if you have additional questions, give Darren a call. He'd be happy to answer them, or, you know, get your buyer pre-approval.
Yeah. Thank you, guys. Thanks for having me on.
Yeah. Awesome. Thanks a lot.
Good one.
All right. Bye.
Bye.